yelling buy, sell, and we see who has the most aggression. So kind of give you a visual. We'll bring back up this one. And this will bring back around from the auction market theory. So from that example, you guys kind of see how it's similar to an auction. Do I got 5, 10? Can I get 15? Well, this is downtrend because we can make money on both ends, but we're going up. We'll go 5, 10, 15, 20. Do I got 25? Do I got 30? So that's how the market moves up until we get to the highest bidder, whoever willing to pay the highest price. It doesn't matter if this price is up here, if somebody's willing to pay for it, market, it's where the market will go to, all the way back down to the lower seller. So there are economics in these charts, but you don't have to be an economist to trade them. You can actually just look at these levels because they give us the blueprints. You see these wicks. You start seeing ranges. You start noticing supply and demand. So you're not doing math calculations. You're not doing, but you do want to know the bare bones are kind of the background story. So let me pull up this right here. Word of advice would be to start, if you really want to take this thing to another level, spend a few moments, back away from trying to find the perfect setup and study some of the greats. There's a good book called Market Wizards. You can YouTube, Forex traders, great Forex traders. And a lot of these concepts you're going to start hearing these guys talk about. And it'll snap the puzzle all the way in full circle. So now you're going to be efficient in whatever strategy you choose to use, whether it's, just an EMA strategy, whether it's going to be something more advanced. Like there's a supply and demand. See, the supply came in, dropped the market. You want to use Bollinger Bands because I can sit here and teach you guys a strategy all day, just like, buying an outer bottom band, sell. But on the times where there's no volatility, where, the market conditions change, where there's no trending, there's only a choppy market, it'll leave you lost in the sauce. And you're just going to be getting your stops hit and you don't know why. And it causes you to revenge trade. It's a vicious cycle. You revenge trade, you scale up, you're losing more money when you just got to scale back and, rein in your psychology. So I even, it's even rough for me to talk about. It kind of gets not redundant, but the psychology, because this is not where the action is. A lot of people like to see the action of us actually trading, but so I'm taking a list of who all I spoke with, and we're gonna break this down and continue to dive into the market. So that'll be my little bit of a lecture on concept. Like I said, just study some of the greats. Jesse Livermore, Richard Wyckoff. You can look at I want to say Peter Branson. What's my guy's name? He's a newer trader. I'm trying to give me 1 second. I'm trying to pull up his name. These guys all made millions and billions in this actual space. I'll post his name in a group. So I'll break down my process real quick before we jump off, and I'll open the floor for any questions. But basically what I'm doing, like I said, I like to start with a 3D approach. I like to have a sentiment bias so I can get a bias of which way I think the market's going to go. Then I like to have, my technicals in line and also my psychology at play. So I like to do what I like to test the market. I like to throw a little bait out there. So I may put like a little micro lot, see how the market reacts, wait for a pullback, put in more size. First thing I'm going to do is I'm going to try to find a sentiment or a bias in the market. I can do that one or two ways. I can either look at the strengths and the weaknesses in these different currencies. And from knowing the background about the currencies, I can come up with a conclusion of which is going to be stronger or weaker. Shortcut though for you guys until we learn all that shortcut is going to be just simply whatever pair you're trading, check out these little economic reports by top tier economists. They're going to tell you what's going on. Look, it even trading bias. I can't make it. It tells you the bias. Like it tells you that they're going to be looking for the big boys and the institutions are going to be looking long. Now these guys are just economists. They don't always trade, so they're not 100%. But that's going to give you a good puzzle piece to the market. So I didn't really read into this yet, so I wouldn't say just go long. Of course, it looks to me it's looking could potentially be bearish, but just off of first sight. So you want to look at these. You can even pull them up. This is something on client positioning. I mean, that couldn't be a better example. Sentiment, client sentiment. Our data shows traders are now net long for the first time since April 14. So people are starting to go long on this pair. Just because the clients aren't representing banks and hedge funds, we'll go deeper into what we call the COT report. The COT report shows the actual banks and institutions. So most retail people are wrong or they lose money 80 to 90% in the market. So that's why I don't listen to a lot of these so-called gurus. And that's how you guys got to get. You got to get into what I call kill the noise and get into the zone. And anybody can trade, but it's that all that outside noise, all the outside, real psychological that makes it hard. It's because we got so much getting thrown at us. But 80 to 90% of the traders are wrong. So you can use what we call a COT, and we can look at what the banks and hedge funds are doing because they look at all this information. They have all this data. So they use that data to make a trading decision on where the economy should go. And usually when most of the retail traders are going one way, the banks are going a complete opposite way. And you just take the trade the way that the bank's going. And probably about 80 to 90% of the time you're gonna win. It's funny. Of course, you got to have the right entry point. Not saying exact or perfect, but you do have to have a good entry because it's based on your account size. So if I go in there and I'm too over leveraged, I can have the trade right. I can have the direction of the trade right, but the trade wrong because other outlining factors. It's not my entry. It's not my time frame. It's that I may have put in too much in the account, so I couldn't hold 30 pips of drawdown. I couldn't hold 50 pips of drawdown. But if I would have sized appropriately, that 50 pips would have paid me out 300 pips just the next day. Let me get how many people, how many in the group has gotten a trade, got stopped out just to see the next bar, the next few candles, it went like 100 pips in your direction. Anybody had that happen?